Welcome to our tutorial on managerial finance. In today's video, we'll be diving deep into what managerial finance is, why it's crucial for businesses, and how you can leverage it for better financial decision-making. Managerial finance involves managing a firm's resources, financing, and investments to maximize shareholder value. It's an area that intersects financial accounting, economics, and finance to provide the tools for better financial management within a company. Let's start with understanding the fundamental concept of financial planning. Financial planning is the process of estimating the capital required and determining its competition. It is the process of framing objectives, policies, procedures, programs, and budgets regarding the financial activities of an enterprise. A typical financial planning question might be, how much capital will a business need over the next fiscal year? And where will that capital come from? Example, if a business anticipates needing $1 million for new equipment and expects to generate $0.5 million from operations, it may plan to raise the additional $0.5 million through a loan. Next, we have capital budgeting. Capital budgeting is the process by which a business determines and evaluates potential large expenses or investments. These can include projects such as building a new plant or investing in a long-term venture. Capital budgeting questions are crucial for a firm's growth. For instance, should we invest in Project A with an expected return of 8% or Project B with an expected return of 10%? Let's visualize the ROI for two projects, Project A and Project B. In this graph, we see that Project B offers a higher ROI than Project A, making it the more attractive option if all other variables are equal. Financing decisions are another cornerstone of managerial finance. This involves deciding the best mix of debt and equity financing. An example question might be, should a company finance a new project with debt or equity, or a combination of both? Consider a scenario where a company can either take a $1 million loan at 5% interest or raise the same amount by issuing shares that may dilute existing ownership. Risk management is also crucial in managerial finance. It involves identifying, analyzing, and mitigating uncertainties in investment decisions. A pertinent risk management question might be, what are the potential risks of investing in a volatile market, and how can they be mitigated? Consider a stock investment in a volatile market with an expected return between 5% if the market declines and 20% if the market performs well. The graph shows different return scenarios. Proper risk management would involve strategies like diversification to spread risk. Now let's talk about financial analysis. This involves evaluating a company's performance and making informed business decisions. It typically involves the use of financial ratios derived from financial statements. Example question, how is the company's liquidity position to meet short-term obligations? Common liquidity ratios include the current ratio, current assets/current liabilities, and the quick ratio, quick assets/current liabilities. An ideal current ratio is generally around 2 to 1, while the quick ratio should be at least 1 to 1. Suppose a company has current assets worth $500,000 and current liabilities worth $250,000. In this case, the company has a current ratio of 2, indicating it has twice the current assets to meet its current liabilities, which is quite healthy. Let's look at a real-world example. Apple's financial ratios from their annual report. The graph shows Apple's current ratio over 5 years. Despite slight fluctuations, Apple's liquidity has remained strong and stable. Another crucial aspect of managerial finance is cost of capital. Cost of capital refers to the return a company needs to achieve in order to justify the cost of a capital project, such as building a new factory. Key question, what is the company's weighted average cost of capital, WACC? This includes both equity and debt. Suppose we have a company with $600,000 in equity at a cost of 8% and $400,000 in debt at a cost of 5%, with a tax rate of 30%. This means the company's WACC is 6.6%, and it needs to generate a return exceeding this to create value. In conclusion, Managerial finance is a comprehensive field that is integral to the strategic planning and operational efficiency of any business. By understanding and effectively leveraging financial planning, capital budgeting, financing decisions, risk management, financial analysis, and cost of capital, you can make informed decisions that steer your organization towards sustained growth and stability. Thank you for watching. Don't forget to like, subscribe, and share this video with others. If you have any questions, please leave them in the comments section below. See you in our next tutorial.